Hello, and welcome back to the FinTech Takes podcast, a special guest podcast edition for all of you today. I am delighted to be joined by QED Investors, Amias Gerety. Amias, thanks for hopping on.
Thank you. Thanks for having me.
Well, I am delighted to have you. We have a very fun topic where we're going to kind of dive deep into a very specific subject that I spent some time thinking about, you spent more time thinking about, but I don't think I've really talked too much about on a podcast. So I'm excited to get into it. Before we do that, for the very small number of listeners who are not already familiar with your august personage, would you mind giving a quick introduction to yourself and your current role?
Yeah, sure. So I'm a partner at QED Investors. I think many of your listeners will know QED is a large global fintech specialist venture firm. So we can invest anywhere from pre-seed to pre-IPO, but at our core, what we do is we try to lead Series A's. So that's what we like to do. We are at this point fully global. And so we're about 10 investing partners. We've been around coming up on 16 years. And then personally, I've been here 7.5 years. So I'm sort of almost through a cycle. And prior to that, I spent a lot of time. I was in the Obama administration. So I did literally the first day to literally the last day of the Obama treasury. Did other things before that. But those are the two major things that make me a fintech nerd.
Awesome. Well, you are indeed a fintech nerd. You're also sort of what I would consider to be ancillary to a fintech nerd, but an area I've been digging into a lot more, which is a bank policy nerd. And that was actually the impetus for you coming on. You wrote a great op-ed for Open Banker a while back titled Freeing Financial Advice from Financial Advisors. And it was a really great piece that, again, sort of blended like this fintech technology innovation lens with a very sort of detailed look at regulatory frameworks that exist around financial advising and sort of how they might not, in some cases, be fit for purpose for where the market will eventually be going. So I want to kind of talk through some of the key ideas from that article. And for folks listening, we will include the link to it in the show notes so you can go read the thing itself. But let's start here. What is the problem with financial advising being a job that's done, as it is for the most part today, by human beings?
Yeah. And so I think I love the way you framed this up, Alex, because the piece doesn't just talk about problems in the regulation of financial advice if we're trying to get AI to do it. But really says, like, why do we even regulate financial advice at all? And when you look at it from that lens, what you come up with is you go deep on what is the problem with financial advice. And this is an old problem, right? This isn't like a modern problem. This is an old problem. So financial lives are very complicated. So financial advice is usually quite complex. And because it's quite complex, it needs to be personalized. But now you have financial advice that needs to be personalized. So you really need to understand both time with the person and financial services. That's probably going to be a very expensive person, right? Per hour of time, this is a person with real expertise, and that so becomes very expensive to provide. And therefore, you end up that financial advice today, when it's given at all, is provided by people who are actually compensated as salespeople. And so therefore, you end up, the problem is that it's costly, it's scarce, and it's conflicted. So humans are just not a great technology for providing scalable financial advice. Right? They're an awesome technology. They're the best technology we've gotten, but they do have this problem, which is humans are very expensive, especially if they have high expertise, and especially if they need to spend real time solving a problem. And that's why we ended up with a sales-oriented financial advice culture. And sales-oriented cultures they're deeply conflicted. And you can't resolve the conflict today with regulation and governance and oversight and training. But those are just lipstick on a pig. The conflict remains.
Right. No, so I really did like how you framed up the problem in the piece, right? Because like fundamentally, I think a lot of times, and I think you guys at QED are really good at not falling into this trap, but a lot of times we're like, ooh, look, a shiny new toy. Let's apply it to this area that's really old because it can't possibly work well because it's old. And like, we don't think about it from a first principles perspective of like, what is the actual problem? Why do these trade-offs exist the way they exist today? And then does technology offer a way to break that trade-off or to change the trade-off in some meaningful way? And so to kind of recap what you just said, the basic idea here is really good financial advice is hard because you have to have a detailed knowledge of financial services and all the various mechanics and tricks and ways that it works and options that are available to you. And you have to marry that detailed knowledge with the detailed knowledge of the individual who you're advising and their financial situation, their goals, their time constraints, all the different parts of it. So merging those two sets of knowledge together to get good advice is really hard and takes time. Thus, if you're going to have a human being do it, I sometimes think about this in the context of like, this is kind of a strange example, but I think about it as like dermatologists, right? Like a dermatologist is a very strange job because fundamentally you're paying a human being to look at every part of your skin. Yeah, that just takes time, right? Like it just
takes time.
There's no kind of way around it, right? Like there's no shortcut. You have to just look at every part of someone's body to be a dermatologist. That's just how it works. And financial advice is kind of like that, right? You just have to look at every single part and synthesize really good advice. And it just takes time. And the people who do it, and apparently dermatologists are actually like, that's the most profitable. It's like the most profitable like area to go into if you go into healthcare. So for I guess 18-year-old high school students listening to this, that might be a career option to consider. You get good hours and get paid great money. But that's the sort of fundamental challenge of making it accessible is it's just hard to do. The strategy or the way that we've sort of found of like widening the accessibility and not solving it by any means, but widening it a little bit is what if we took that expertise, but we compensated it not in paying for that advice as you're getting it, but in giving someone a commission for selling financial products as a part of the exercise of giving advice. And this, of course, fits into lots of different models, everything from, sort of financial advisors who are not like certified financial planners, but are sort of like have the broader title of a financial advisor that makes you think they're giving you unbiased advice, but they're actually not. All the way to like, I joke sometimes that if you look at like a list of best checking accounts to get on NerdWallet, you're going to see a list of checking accounts from banks you've never heard of. And it's because they're being paid to make those recommendations, right? So all of that is a version of giving advice that is biased inherently by the need to sell it, which is how we make it more accessible in the first place. So there's this trade-off that we have. That is, I guess, what I would call kind of a supply side problem in terms of the ability to supply financial advice in a sort of cost-effective manner. I also wanted to ask, and this was, I think, a little less of the piece you wrote, but I know you have an opinion about this, the demand side of financial advice. So, as you said, financial services, very complex space. We know, based on copious amounts of research, as well as just basic intuition for anyone who's tried to do this, financial education doesn't really work. And I think you did point this out in your article, which is a really great point. There's also a lot of like embarrassment and even shame that influences people's willingness to like ask questions and get help here. So when you think about the demand side of the market for financial advice, how do we think about that space? What are the drivers there?
Yeah, so I think this is complicated on, just we talked about. This is complicated on the personal side and on the finance side. And at some level, most financial advice that doesn't come in this very high cost, high touch way boils down to dieting advice, right? It's like, hey, do you know that you should save more and spend less? Right? Like, yes, I do know that. I do, in fact. Like, do you know that you should exercise more and eat less? Do you know that you should put on sunscreen? Like, yes, I know all these things. Now,
well, there are these rules of thumb, right? Like I always think about, I don't know if we're of the same general generation, but like when I was in school, the food pyramid, like these kind of rules of thumb get locked into your brain as like, I know certain things. And even like, don't spend more than, 30% on rent or a mortgage of your like disposable income. Like there are these rules of thumb that take hold as very general guidance, but to your point, that doesn't mean it motivates behavior.
Yeah. And so what we see in financial advice is, 15, 20% of people, depending on the age range, just get zero financial advice at all.
Yeah.
And then another 15, 20% get it from a friend. And like maybe, hey, I actually think I could get great financial advice from my friends.
Sure,
right?
sure.
I have like
You swim in
very
the right
financially
waters.
sophisticated friends, right? I'm not sure that's true everywhere in the country. And so what that speaks to, I think, is just to, and I think this is very natural to understand why this is. It's like, I want someone who knows me when I get financial advice. I want someone who I'm not going to be embarrassed to ask questions of.
Yeah.
Because I want to be willing to ask a dumb question. And by the way, a dumb and very personal question.
Yes.
Like, hey, so, because if you really, your financial advice really, it's very different if you've got $1,000 in your bank account or if you've got 100. It's very different if you've got 50,000 than 10. And so even there, like think about how close you need to be to someone or how trusting you need to be before you're willing to tell them your actual bank account balance.
Yep.
Right. So this shame stuff, I mean, it's so like, it's very easy for us to like, read the literature. Oh, why should people be embarrassed to talk about their finances? But I always like to personalize it. Like, how many people, Alex, do you know that you're willing to like literally walk through your net worth with?
Yeah.
Right?
Like count on one hand, less than that.
One hand.
Yeah, totally.
Yeah, exactly.
One person, maybe my wife, that's about it. Like, honestly, like it's a very small list. Yeah.
It's a very small list. And so, I think we have to take seriously this combination of personal complication and financial complication. And that's where we always start. Now, I look at like, what's Gen 1 of this? Think about your old Mint, or think about 36 personal financial management startups that are started every year. Or if you've ever gone to an MBA course and asked them to give you a pitch, 9 out of 10 pitches will be personal financial management.
It's the it's the eternal place. Everyone always starts with this stuff. Yeah.
It's the eternal place. And I think Mint was an awesome Gen 1.
Oh, sure.
But Mint was like a gym. The people who got value out of the gym were already fitness fanatics.
I call it the 15% rule, which is like PFM always gets to about 15%, and then getting the other 85% to cross the chasm is basically impossible, because 15% are just wired to think this way and to want these tools, and like that's just the way that their brain works, and it's how they approach, that's how they see the world. Everyone else is the problem.
Yeah. And look, I mean, so I've got 3 brothers. During COVID, we had like some different behaviors, right? And I was talking with my brother, and he was like, man, during COVID, I started drinking too much and I ate way too much sugar. And I was like, oh, when COVID started, I gave up sugar and alcohol and I started working out every single day. And my brother said to me, Amias, it doesn't count if it's already part of your personality.
Totally.
Right. And I think this is the thing. So, I thought it's such a good line, right? Like, my brother's a healthy, fit guy, but like when that kind of crazy break happened, he went the way many people did. And I was like, oh, every day I'm becoming a monk. Like I just went into like stress monk zone instead of like stress eat mode.
Totally.
But that's my personality. And so I shouldn't give advice that's like, hey, you know how to get financially fit? Like
totally.
Eat your vegetables.
I
think that's what we need. And ultimately the promise here is true personalization and true coaching, right? Financial planning is you're putting your trust in someone. You're asking them for them to help you get your goals, and their job, it's very similar to counseling a founder, right? Their job is to say words that increase the likelihood of you doing good behavior. And that's why the conflict is so dangerous or so important in financial advice. Because the whole construct is you're coming to me for help changing your behavior.
Yeah.
And so if I'm not purely aligned with you,
Mm-hmm.
and I am good at my job, I'm going to get you to do the behavior that's good for me.
Yeah.
Irrespective of whether it's good for you. Now, I'm not saying that these conflicts are actually necessarily bad. Like, if I'm an investment manager,
Mm-hmm.
and I'm trying to get you to save more so you can invest more for retirement, that's probably good for you and for me.
Sure.
But it is different, right?
Yeah.
And sometimes the micro incentives, like this particular product versus that one. So that's why we have a pretty thick regulatory architecture around financial advice.
Mm-hmm. So, all right. So then if we sort of jump forward into, as you were describing it, like V1, V2, V3 of this, I mean, it's not a new idea that we could apply technology to solve this problem, right? And to your point, I mean, I think the core kind of takeaway I came away with the piece is like that gold standard of financial advice. If that was just more broadly available, it would be the best sort of outcome for everyone, right? And not that the sales driven model can't be useful in certain parts. I certainly take advantage of it where it makes sense, but you always have to be sort of on guard. What you want is for people to pay for good, unbiased financial advice. You just don't want to have to make them pay an arm and a leg for it. And so
that's exactly right. Like I've used a realtor when I buy a house, but I remember like I was talking to a friend who was buying a house for the first time, and she was saying, well, the realtor thinks I should bid up a little bit. And I was like, the realtor is not on your side.
No, that is 100% true.
The realtor wants the deal to close. Now, that isn't like, they aren't even being a bad person.
Yeah,
right?
yeah. It's just they have a natural incentive.
Right. You like this house.
Yeah.
You want the house now. If you
I want to get you
bid,
the house now. Yeah. Right.
I'm aligned with you.
Yes.
But that's a little bit different.
It's a great point. I remember seeing a study that was saying that they looked at when realtors list their own house for sale and the amount of time they stay on the market versus when they are helping someone sell their house. And it's like double the amount of time they leave it on the market, right? Because like if your goal is not to get a commission, but to get the best possible price for your house, different incentive. And suddenly we're playing a slightly different game. So no, I think that makes total sense. So if we apply the idea of computers and machines to this problem, as anything where human beings are sort of the inefficient bottleneck, technology is oftentimes the answer to that problem. However, in your piece, I thought you did a good job of sort of articulating why it is that technology, which again, entrepreneurs in this space have been looking at this problem exactly the way you're looking at it for a while, why we haven't quite cracked the code on it. So I want to talk through a couple different pieces of it. So we talked about PFM and budgeting. And I think, as you said, like, if you're a warrior monk in your heart of hearts, you're going to naturally gravitate to these types of things. If you're more like me, you probably won't. And so like there's that sort of 15% problem that exists with apps that require you to engage deeply with them in the same way that lifting weights requires you to lift heavy things. Second, I think if I think about these in sort of generational cohorts, is this notion of like robo-advising. And robo-advisors, Wealthfront, Betterment, et al., it's funny, like they're kind of considered like old now and like not fintech in a way, which is funny. This space reinvents itself so often that like I'll talk to a 22-year-old. They're like, "Isn't Wealthfront really old?" I'm like, "Well, maybe, but then I'm really old too." So like I actually think Wealthfront and Betterment did do a really good job in moving the ball forward in certain places, but also it's not the end all be all answer to this problem. What's your take on sort of that generation of advising?
I love these guys as existence proof of the idea, right? Another thing that we've all heard the pitch so many times in fintech, self-driving money.
I knew you were going to say that. I knew it.
Right? Everybody loves self-driving money. And totally. I really want to give a huge amount of credit to Wealthfront and Betterment because they're and other robo-advisors because they're actually the only people, the only companies that have even any workable version of self-driving money. And so I think they deserve a huge amount of credit about that. And I think it really makes clear that self-driving money is both possible and hard. And so one of the things that I did in the piece, and I think it's often underappreciated, is the regulatory architecture and the theoretical, empirical economic work that goes into Betterment and Wealthfront being able to do self-driving money as fiduciary actors for their clients. And so just to unpack that a bit, every registered investment advisor has what's called the highest standard that you can have. It's an old idea, common law theory, which is the fiduciary standard. And the fiduciary is, that I would act on your behalf as if it were me. So that's the fiduciary standard. So it's the highest standard that you can set in kind of any US law. And yet it's the first place that we've seen automated self-driving money. So that's very interesting. Mm-hmm. And when you ask yourself, well, why is that? You have to get to another thing, which is modern portfolio theory and the notion in economics of an efficient frontier. Mm-hmm. And so over the last 50 years or so, Eugene Fama, others like with the the efficient market hypothesis and risk return trade-offs, they demonstrated that there was in fact an efficient frontier of risk to reward. And because of that, there's an efficient frontier
answer.
Because of that, there's a mathematical answer. And because there's a mathematical answer, Betterment, Wealthfront, and others were able to convince the SEC that they were fulfilling their fiduciary duties while executing in a very automated way and executing in a relatively narrow way, right? There aren't actually that many. There aren't a million different Wealthfront portfolios.
Right. So, okay, so let me unpack that. So that's really interesting. So the idea is basically that in a narrow set of circumstances, there is a arguably mathematical answer to the question of what the right thing to do is for a consumer financially. And because of that, there is this sort of arguable ability to meet that fiduciary standard while doing it in a way that doesn't require human beings to actually be touching the dials and levers and buttons. What's really interesting to me about that, and this ties right back to self-driving money, is I love the concept of self-driving money because it parallels the development of self-driving cars. And I wrote a piece about this a couple of years ago, but it's so funny to me because the parallels are really striking. We get all excited about self-driving money and self-driving cars, circa like late 2000s, early 2010s, and everyone gets all spun up about it. And much in the same way that Betterment and Wealthfront did actually demonstrate that this works and is possible, and got some level of regulatory kind of blessing or non-objection around certain ways of doing that in limited conditions. Self-driving cars were kind of similar, right? Like it was in those very early days with whatever the prior version of Waymo was called, and some of these very early tests that were done, like they actually demonstrated we can build a robot that can drive a car. I think it was DARPA actually that was doing some of the very early tests on it, where they'd go out to the Mojave Desert and like you drive around on a track and you could have a robot car do that. So the basic technology of doing self-driving cars, much like the basics of doing self-driving money, can meet a very good standard under certain conditions. But then we get to, I guess, what Gartner would call the trough of disillusionment for any new technology, which is all of a sudden we start going, well, okay, let's take our self-driving car out on the highway or on the streets of Pasadena or wherever it is that we're going to be going. And we introduce all of these complexities to applying this framework more broadly to driving, or in the case of self-driving money, going beyond the very sort of narrow things that Wealthfront and Betterment built and demonstrated was possible into this broader concept of self-driving money. And this, I think, is where we bring in AI and large language models and foundation models, because this is the other thing that you talk about in the piece is, okay, so we've demonstrated some of this is possible. What is the next frontier? And how do we climb out of that trough of disillusionment to get to kind of the end state that we're talking about?
Yeah, so I love the analogy to self-driving cars. I want to tell you about the first time I was in a self-driving car. So I was in Las Vegas.
Okay.
And I get in, and I was like, oh, there's a way to call a self-driving car on the Uber or the Lyft app or whatever it was. So I was like, this is super fun. I definitely, I'm a future-oriented person. I want to do this. I'm doing it.
Yeah.
So I get in the car, and there are 2 drivers.
Yes.
Because there was the self-driving car, the driver, and a quality control engineer who was there to answer any questions I might have. And then the car, the real human driver prepared to pull the car out, and did pull the car out of the casino, onto the strip. Then the self-driving car started driving. At this point, the quality control engineer told me that the self-driving car was driving.
Sure.
And then, as the self-driving car prepared to turn into my destination, the human driver took over again. So I think this is, it perfectly parallels, because I think a lot of what we are seeing today is there's a little automation, right? So, and at some level, credit, or some of the fintechs to do earned wage access, or to give you, these overdraft protection plans that can look at where your balance is going to be. And if you pay a fee or you tip or whatever the model is, they can automatically give you a loan.
Do you remember Digit? I loved Digit, where it would just squirrel a little bit of money away into a savings account, like super simple automation, but it would it would look at your cash flow, and it would like try not to overdraw your account, but like it was awesome. But I guess in the same way, to use the self-driving car analogy, it was awesome in the same way that like cruise
driving
control on the highway
on the Las Vegas Strip is.
Or like parking assist, or some of these things that are like cool but very limited.
Yeah, that's right. And I was so excited when I bought a car that had parking assist, and I use it never.
Right. Exactly.
Yeah,
because
it's just not quite good enough. Like I live in Washington, D.C. We don't have a garage, so I am constantly putting my car into the spots that the parking assist says are not spots.
It's not feasible. Yeah.
But I think where we are today, and with the advent of LLMs, we are approaching a point where I think you can really start to see that this could be exciting and it could work. And so I want to spend a little bit of time just to motivate that this actually could be awesome. And so it's a little bit crazy, but we know computers are really good at math. They're really good at long lists. They're really good at storing lots and lots of information. And we know that LLMs now are infinitely patient. You can ask them questions at any time. They don't get tired. And they're actually quite good at explaining things at various levels of detail. And so when you envision the possibility of getting financial advice, this is a tantalizing combination. So one of my first realizations, we had one of our companies in our portfolio, it's based in Mexico, it's called Callru, and they were a financial coaching platform. So some of these early automations, but they actually had advisors, that
they
you could
coaches,
call. They had coaches, and they started experimenting with GPT when it came out. And they, Fernando gave for the CEO and our partner started to just take us down a path. And so I said, okay, great, let's do this. So I want to buy I need a mortgage. Well, why do you need a mortgage? Well, you're going to buy a house. Okay, well, where are you going to buy the house? Well, what's a good zip code? Well, what's the school district like? Can you give me a sense for how far, what's the commute going to be like? That's not financial advice, but an LLM can handle it, no problem.
Yeah.
Now it's hallucinating a little bit at the margins, right? But it could, hey, give me the best school district by some public rating relative to house price per square foot within 30 minutes of downtown DC. That there is no financial advisor on earth who can do that calculation, and an LLM can do that calculation.
And to your point, the thing that's interesting there is that and this is something I've written about a lot in various contexts, but it's it kind of speaks to why financial advising is so hard. Financial services sits right next to every other part of our life all the time, right? And so it's very rare I guess you'd be in a very privileged position if like you needed financial advice that was utterly disconnected from real life. I guess if you have like $100 million and you're trying to figure out how to make $100 million become $200 million, like that's probably a pure financial services exercise. But for everyone else who lives in the real world, financial decisions are connected to real things. And so I think one of the points you're making there is that the breadth of what LLMs can do is significantly greater than you can really expect from any single individual human, where it can blend financial advice about, oh, here's how to think about getting a mortgage. Here are the things that drive kind of the costs of it. Here's what can affect, long-term financial outcomes, short-term financial outcomes. But it can also then seamlessly move from that to, oh yeah, let's have a conversation about, school zones and zip codes and commutes. Like it can seamlessly blend all those things together in a way that's probably pretty cool for the average user.
Yeah, and it speaks that personalization and that shame and frustration, right? Like if you're paying $1,000 an hour, which would probably be relatively cheap,
yeah,
for a financial advisor, for a certified financial planner,
mm-hmm.
and then all of a sudden you've spent 10 minutes talking about zip codes,
yeah,
you're wasting your time, right?
Totally. Because they're not an expert in zip codes. Yeah, right.
Exactly.
Yeah.
Or like, well, gosh, what's normal for people who are buying a house? Is it like maybe $10,000 of construction costs to make sure? Or should I take the, how do I read a home inspection report?
Yeah.
Right. Like now there are probably financial planners who are pretty good at answering those types of questions because, frankly, the financial planning industry's age is relatively high. And so they're probably
right.
relatively experienced.
They've seen a lot. Yeah.
But again, you're kind of wasting their time because that's not what you're paying them for. And then at the bottom end of the sort of, how much money you have in your bank account, the advice can get very simple, right? Like if you only have $100 in your bank account right now, the answer is do what you can to get that number to 500. Because at 500 you can handle it. So there are things, and that's more about motivation and coaching.
Yep.
Now, this motivation and coaching, I think, is a place that is really interesting with LLMs.
I agree with you.
Because we know that LLMs, when kind of instructed, can be crazy persuasive.
Totally. Alarmingly in some cases.
But that's scary.
That's useful. Yeah.
It's useful, it's scary, it's both.
It's so wild, right? I remember when I think it was the New York Times wrote a piece about one of the early versions of GPT, or maybe it was Microsoft's version of it, and it was like convincing it to like the bot was like building a personal relationship with the person and like trying to convince him to like leave his wife. You remember that one?
Yeah, you're right. That was I chatted with OpenAI for 4 hours. Here's what I learned. But there are examples of this, Alex, that are kind of well documented in the computer science literature about like a bot that tries to convince you to let it out. Right. It's sort of a version of the Turing test, right? And or even a person who says, okay, like I am a bot. I'm going to pretend I'm a bot.
Yep.
Your job is to not let me out.
Yep.
How long does it take before you tell me you actually write the code? I will let you out.
Yep.
And so we know that these LLMs can be really persuasive. And that, again, is tantalizing in a slightly scarier way.
Totally.
Because in some ways, the idea that I could hire a bot to be very persuasive to get me to save, and I didn't talk about this in the piece, but that sounds great, right?
Except, I mean, you pay coaches for it. You pay all kinds of things for it.
You pay coaches to it.
Yeah.
But imagine that bot is lying to you about what the market is doing. Hey, you've got to save because the world's about to end.
Totally.
Right.
Totally.
Or they harass you, right? Like the bot.
Well, or they have a financial incentive, right? This goes back to your thing about business models, right? Like if they they're a very powerful tool, but what they're connected to, how they are incentivized, what they're instructed to do. Like, I guess the point you're making is these things are incredibly powerful, which is both tantalizing, but also dangerous depending on the structure that we end with. So that's a good transition, because the other thing you talk a lot about in the piece is, okay, so what's the model here? Like this is tantalizing technology. It clearly could add a ton of value here. It could, in the same way that we've actually made some really significant advances in self-driving cars, navigating more complex environments. LLMs can have a similar effect in financial advising, right? They can broaden the scope of what we can do and make them more generally useful at a higher level. However, how do we deploy it? What rules do we wrap around it? What do we accept as a standard that we can live with? What do we not accept? So you mentioned a couple things in the piece. One was the notion of the co-pilot model, right? Which is very common in the world of generative AI right now. And the basic framework here is that the AI is going to sit next to a person. I guess like your self-driving car experience in Las Vegas. They're going to work kind of in tandem with each other. They will make the human being better. And I guess the argument for your self-driving car experience is maybe I know they were still testing it, but like maybe the self-driving car, when it got out onto the strip, was slightly less likely to get distracted or get into an accident than a human driver. Maybe, I don't know. So like that, in certain circumstances, it can provide value. But, and you made this point very clearly in your piece, all of the existing expectations and regulatory frameworks and legal liability and everything that we've sort of developed still works, because at the end of the day, the human being is the one doing the thing, even if it's being advised by an LLM or an AI agent. And so we can still keep that same framework sort of tied to that individual. Is that right?
Yeah, that's right. So this is obviously where we're going to start.
Yeah.
And so I don't want to be too negative on it. But I do want to point out that it's a kind of a dodge.
Yeah.
And it's a kind of a dodge for two reasons. One is if we take it seriously and the human is still doing the work,
yeah,
or is still really thinking hard about the person that they're advising, we're only getting, a little bit of benefit.
We're not saving that much money here.
We're not saving that much money. And the cost of quality financial advice is so high that even a 2x or a 3x improvement in productivity does not move the needle in terms of affordability.
Yeah.
For regular people.
Yep.
Right. So you can move it from $1,000 an hour to $300 an hour. Okay. But, we know a lot of people it exists in this country who don't have $300 in their bank account, right? So,
totally. Yeah.
So this is, I think, where it will be how we start, and it will be, it is good.
Yep.
And it's good mainly because it should actually make them better, right? It should be more like the AI assisted radiologist, but I don't think it solves the problem of scarcity. And I think, and then I think the other piece that we need to be really on the lookout for is that this regulatory dodge, where because there's a human, we ignore the fact that we haven't answered the hard question, which is what is good financial advice? We haven't answered the efficient frontier question for general financial advice, for insurance financial advice, for savings financial advice, for mortgage financial advice. We haven't answered the efficient frontier problem. And as long as there's a co-pilot, then as we drive towards efficiency, that human is going to think less and less and less. And their role in the worst cases becomes a pure regulatory arbitrage, where their job is to stamp what the computer does so that we don't have to think about the fact that the computer is doing the work and we do not have a legal or regulatory architecture or even a governance or moral architecture for the computer to take a licensing exam, for the computer to raise its right hand and say, I will abide by the rules of this self-governing organization. And so I think the reason the co-pilot model has these problems is the best case, it only gives us a moderate benefit. And in the worst case, it ends up that the human is a pure rubber stamp. And so they're fulfilling the regulatory work without actually doing anything to further the purpose of the regulation.
Right. So we get the cost, and then we actually kind of backslide a little bit on the benefits potentially. Yeah, that's super interesting. So, all right, then if we flip it around and we talk about what the regulatory and legal and moral architecture might be, let's say that we do sort of just put financial advising fully in the hands of this technology. And, let's say that we continue to make progress on hallucinations and on sort of narrowing the parameters under which these things can work in such a way that we feel like we're getting better and making more progress there. So say the technology continues to kind of evolve as it is. What is the regulatory and moral architecture that we need to build around a fully automated sort of agentic approach to financial advising?
Yeah. So what I'm about to say is like all stuff about the future. It's obviously wrong, but I want to point out that it is at least theoretically possible to have things that don't feel incredibly detailed or techno-centered.
Yeah.
Right. Because I think if we have a framework where the regulation has to chase into the neural architecture, we're very likely to lose. Right. So what I try to outline is this idea that we don't really have a framework, and we should not try to think about a framework where the computer makes us any moral promises. Right. But because it is a computer, it has different capabilities, and those capabilities are accessible in relatively simple terms. So I think there are two that are kind of straightforward in air quotes, and one that is really hard. But let's talk through what are these: training, calculation, and definitions. Right? So most people who interact with the world of AI are accustomed to the idea of, oh, AI is a black box. Oh, we don't really know how these training models work. Oh, we don't know how they think. And they can sort of tell us, but like, is that really what they're thinking? Blah, blah, blah. And what I would say in that zone is that even as complicated as that work is, the training methods, the optimization frameworks, the reinforcement frameworks are actually quite simple, usually, and they exist outside of the complexity of the computer system itself. So just to take everyone's favorite, OpenAI, one of the big knocks on OpenAI when it first came out is, oh, it's just predicting the next word. So this is kind of some kind of a magic trick. Mm-hmm. Well, that's sort of true and not true, right? It was just predicting the next word. That's what the model was doing. So it was a kind of
next token, yeah.
Mm-hmm. However, it was incredibly good at doing all the things that we've talked about, even though that and that next token is the training optimizer.
Yeah.
Please, computer, predict the next best word in the mind of a human user. Mm-hmm. And so I think because that, we can see that even a model as complicated and as amazing as some of these foundational LLMs was trained using a very simple principle that was very easy for a regular human to understand. Mm-hmm. And so I think that there's a possibility that we could do the same thing when we come to regulate the LLMs models when they provide financial advice. So you could say, for example, I want to see a regulator could say, I want to see the training optimization parameters. And these would not be the model weights because they would have per se, they have to have been designed prior to the training, right? So they're not as proprietary. And they could say like, the obvious thing that if you and I were designing this in the most economical way, we would say, choose the words that get them to buy our insurance product.
Right. Well, you made this point. I think you analogized it to like social media, right? And like engagement. Like these social media algorithms are incredibly complex, but the training goal, I think, is kind of another way of describing it. The goal is very simple, which is make someone keep scrolling, make someone keep clicking. And so it's like you can get lost in the sauce of how complex the algorithm is in terms of how it does that, but you can very easily point to some human being working inside these companies who said, make this number go up, make people click on this, make people scroll. Those are simple goals that you can hold people to. Is that a fair way of thinking about it?
Okay. That's exactly right. And I think what we shouldn't do is relatively obvious. What we should do is hard. So what we should do comes back to this issue, which is the hardest thing, which is the definitions. But let me go from, so training, we know, and I think I really want to communicate to people who don't work in these systems these training principles are often quite simple and easy for humans to understand.
Yep.
And that's very powerful.
Defined by humans. So we can
That's right.
we can change that, we can understand it. Okay.
So you can certainly say, I want to see your training parameters, and I want to be assured that they did not say you are trying to sell insurance products.
Right.
I want them to say something else. Now, what that something else should be, that's a little bit hard, but at the very least, it should be something that is about my financial well-being.
Yes.
Not about your compensation. So that's easy.
Makes sense.
Easy, right? It's recognizable. You could write it.
Yep.
The second thing is calculations. We know LLMs are bad at calculations, right? Ask it to do math. Ask it to, the strawberry idea. How many R's are in strawberry, right? It can't count them. So we know that that's true. But we also know computers are good at math.
Right. We're not limited to one tool here.
We're not limited to one tool. And we also know that every financial product, it does have a mathematical equation in its back.
Sure. Yeah.
Right? At its base. Now, this is where we get to take advantage of the fact that this could actually be better than humans. Like, nobody in the history of the world has thought that a regular way independent mortgage broker actually knew the detailed mathematics of the mortgage product that they were helping originate. Nobody ever thought that a regular way life insurance or annuities agent actually understood the detailed mathematics of the whole variable annuity product. That's just not an expectation that we have. And what I'm about to propose will make some people in the industry a little bit crazy if it were actually right down in a rule. So let me just say, as a direction you could go to, you absolutely could connect two computer systems.
Yeah,
the detailed math of the variable annuity, the detailed math of the mortgage, and the LLM output. And that is something you could connect because they're both computer systems.
And the benefit of connecting those computer systems in that way is that we can separate the LLM where, to your point, we can understand the training parameters and the objective it's given. We probably are going to have a harder time parsing how it does what it does, although that doesn't necessarily matter. And I know we're circling back to something on that side. But on the non-LLM computer that we're connecting to it, this is just like machine learning. This is just standard like decision trees. Like, this is easy stuff that you code as a human being. You put the financial product in there. We can check the math. We can look at it. We can audit it. We can understand exactly why it's doing what it's doing. It's deterministic, to use
it's a mechanical sort of language system
that's being talked
about.
That's right.
Yeah. And I think it would be really exciting to say, if you are talking to a client, that when they ask a question, you have to calculate it based on the actual engine of the financial product they're asking about.
Right. Don't freelance on this. Go over here. Yeah.
That's right. And we know that doesn't happen today. Because it's not a reasonable expectation.
Right.
For a human. And this comes back to, like, what's the exciting part? Go back to that shame. I mean, I don't understand how a mortgage works. So I want to ask 100 questions. Well, what if I want to sell the company? What if I sell the house in 3 years? What if I sell the house in 4 years? What if I sell the house in 4.5 years? What if I sell the house in 7 years, 322 days? The LLM doesn't mind.
You have the LLM on the front end doing what it does, which is understanding intent, context, language. Oh, I get what the customer's asking. And then on the back end, they translate that in the requests that go to the other system that's giving you the mathematical answers when you're spitting in the inputs. Makes sense.
Yeah. And the possibility of a high integrity, high volume, relatively cheap system, again, I just keep coming back to this word, is tantalizing. So let's go to the last thing, which is so hard. What does it mean to give someone good financial advice? And here we have, there's lots of things to play around with. I think most people who've spent time thinking about AI are familiar with the paperclip maximizer, the idea that, like, if you told an infinitely powerful AI system to make as many paperclips as it could, it might decide that the best way to do that would be to kill all the humans and use all of or enslave all the humans and turn them into paperclip producers or whatever, right? Some horrible situation. So I don't want to be cavalier about how hard it would be to define what good advice would be. But this is why I think the robo-advisor example is so powerful, because it's an existence proof that where there is well-grounded mathematical work, well-grounded empirical work, and some kind of agreement, we actually can meet very high moral standards with simple mathematical approaches. And so, I've been trying to brainstorm, and I don't know these are right, but what could those positive training parameters be, right? Hey, I want you to, I want the actions to be measured. You should optimize for getting people to save more. Okay, well, but I also don't want you to harass them, right?
Right.
Imagine an AI that then goes in your phone and turns off your notification silences,
right,
and wakes you up at 3 a.m. and says, you still haven't met your savings goal, right? That might be super effective.
Yeah. Or it does the thing that debt collectors do in the Philippines where they call all your contacts and tell them what a loser you are because you're not saving enough, right? You could imagine some bad outcomes. But,
right. It's the paperclip maximizing story writes itself here.
It does.
So you have to be careful about the guardrails. But I do think you could set standards. And by the way, we can write the fiduciary duty. We could try writing it in and see what happens.
Sure.
So I think that to me is the most exciting and interesting question here from a policy perspective is there a way for us to generate real consensus around what would be best? And is there a way for us to assure that the system delivers recommendations that approximate the idea of a rational consumer with perfect information?
Yep. Nope. That makes sense. All right. So before I let you go, let me do a couple quick lightning round questions. Are you ready?
Yeah, let's do it.
All right. So the first one that I am curious about is kind of building on your point about the sort of moral and legal architecture that we need to build around it. We've already seen some examples of AI agents, and I put agents in quotes because I'm not sure exactly what they're based on or how sophisticated they are, making mistakes in dealing with customers, and companies trying, I would say, sort of creative legal strategies to escape liability for the mistakes made by their agents. There was a well-known story about a customer for Air Canada who was talking to their AI agent or bot, and it invented some kind of customer discount for the customer that was not real. And the customer ended up complaining that this happened. And Air Canada tried to make the case that the model itself was responsible for its own actions and that they should not be liable. I bring this example up only to say that companies, regardless of what rules you put in place, are extraordinarily motivated and clever to try to worm their way out of liability. How do you think that part fits into this?
I think it's really hard. I think this is a value chain question. This is a supply chain question. And I recently wrote a piece on the idea of robot insurance, kind of playing with a similar idea. But the idea that the people who want AI in the systems will have incentives to offer guarantees. Then those people who are consumers will have incentives to offer guarantees to the consumers. And when you flow that through, there is some economics here that will probably be negotiated either contractually or with insurance. But I don't. I'm not a big AAGI guy. I don't think we're there yet. So I think it's laughable that this is something where the agent takes responsibility for itself. But I do think this is a supply chain problem. And as LLM companies realize their incentives are to get enterprise use cases, to get this to make real difference in the economy, I think that's incentive enough that this gets figured out contractually with insurance and liability protections.
Yeah, and that makes sense to me. I mean, it reminds me a little bit of the development of payment networks, right? Where it's people complain all the time about, oh my gosh, I can't believe interchange rates on credit cards are 2 to 3%. Well, it's really what it is it's dispute management, and it's all the sort of stuff that gets wrapped around it where someone has to pay for this to happen at some point in the supply chain. And I would imagine that to your point, like if you want enterprise adoption of this thing, you need to build a little bit of extra economics into it in order for that sort of risk to flow through the right places in the supply chain. Next question. We talked about, obviously, like a fully automated system for giving advice. Do you envision that one day being connected to a automated system for executing the advice? So like to this is where self-driving cars as an analogy kind of breaks down a little bit, because obviously the car is in control of itself and making decisions. In financial services, there's this sort of, I guess, intention action gap that we have struggled to solve for a long time, which is, okay, you got access to great advice, maybe even much better advice than you could have gotten before, advice that was only available 10 years ago to people who'd pay $1,000 an hour for it, but you still need to do the thing that you're getting advice on. If this is all driven by agentic workflows, one could imagine those workflows extending into actually taking actions on behalf of customers. Do you see that as a short-term, medium-term, long-term? Where's that fall out?
I think it comes pretty quickly because it will be defined narrowly. So I think once we define the realm of actions that can be taken, hey, do this for me comes pretty quickly. And I'll use coding as an example. The age of AI has turned me back into a coder, and I'm not a technical person, but I'm using, like many people are, Cursor. And, Cursor has a chat on the side, and then it says, would you like me to implement this for you?
Yeah.
Like, yes.
Yeah. I would.
Yes, please,
and
thank you. Yes, please, and thank you. So I think as we start to design and get comfortable with the quality of advice, even if it's very simple, like your example with Digit, the automated saving, I think it is very straightforward that would lead into, would you like me to do this for you? Yes. And I think that is also what's exciting here, is because it operates inside of a computer system, you could see a real breakdown of the intention action gap. And that would be, I think, very good for people's financial lives.
Oh, I totally agree. I mean, I have compared it to, like, we do a lot of times, we compare financial services and health and, physical health. And you and I have talked about that already in this podcast. But one of the challenges of physical health is there's only so much you can do to close the intention action gap automatically. Like, at the end of the day, I need to go for a run with my own physical body. I need to lift weights. I need to put healthier food in my body. Like, these are things that I have to do myself to get the outcome.
Yeah, but you eventually it will be true. And every time I go to the dermatologist, I ask her, like, hey, when is it going to be in my phone that my wife can just scan my back and identify whether any of my moles have changed?
Totally. It's not that far away, right? And then in financial services, it's even greater because there's very few things actually that I need to physically push the button and do to get the benefit of. And so if the machine can push the button for me, I think that's really interesting. Final question, and then I promise I will let you go because I've kept you a little over. You wrote this piece for Open Banker, which again, everyone should go read, link in the show notes, before we knew the results of the presidential election. Can you give us a sense just of how you see, and I know we're still waiting to fully understand kind of what the new administration is going to look like from a financial services policy perspective, but from kind of what you can tell so far, is this an idea that you think is going to get traction over the next 4 years? How does this map to kind of the current and coming regulatory environment?
So I think it's very obvious that they will label deregulation under the banner of innovation.
Yes.
Right. So there will be a step back in regulatory oversight in financial services in a pretty significant way, and that will be labeled and motivated under the banner of innovation. So I think you will see more, and therefore a lot more comfort with experimentation. I will say that I think that the challenge here is that we've talked about a lot of ways this could go off the rails.
Yeah.
And I think that the simplest word, the simplest world is this deeply conflicted AI advice. right? Just use the AI to do something even more conflicted
Right,
and
right.
let her rip, right? And so I do think we need to be on the lookout here. And actually, a lot of this financial advice is actually, is more state than federal.
Yeah, sure.
But really making sure that I think there's incredible opportunity to use AI to give us less conflicted advice.
Yep.
And so I think there will definitely be hands off. That will lead to more experimentation. But of course, the challenge is that I think the best answer will come where the experimentation is guided by actually pretty tight rules on conflicts. And so I'm hopeful that like those kind of basic principles come into place, and then the experimentation will happen within that.
Yeah, no, that seems fair. David Sachs, if you happen to be listening to this podcast, you can reach out to Amias at any time, and I'm sure he'll have lots of advice on the regulation of AI and how it intersects with financial services. Amias, thank you. This was super fun.
Thank you, Alex.
We'll have you on again. Appreciate it.
All right. Talk soon.